Hello everyone, welcome back to another chapter 11, that is all about our cash flow estimation and risk analysis. Let's open our PowerPoint for this chapter. Okay, so this is our PowerPoint for chapter 11. Cash flow estimation and risk analysis. We have several concepts to discuss in this chapter. Uh, I have summarized few points. Let's open that supplementary PPT. Okay, so if you remember the project evaluation from our chapter 10, that is using several capital budgeting project technique, for example, net present value, IRR, MIRR, payback period method, and in that chapter we use this two projects cash flow to show some examples using project evaluation technique. So, say project A and B, our initial investment for project A was $42,000. Project B initial investment was $45,000, and we expected that project A will give us $14,000 for next 5 years, and project B will give us some random cash flow over the next 5 years. But the question is, how or from where we can get this $14,000 each year for next 5 years for project A, and $28,000, $12,000, and then three $10,000 for next 5 years for project B. Where we got these numbers? Actually, these numbers, I mean, these cash flows will be occurred in future, next 5 years from now. We don't know the actual figures, so this number actually came from our estimation. So that estimation is all about our chapter 11. So in this chapter we need to consider the relevant cash flows, and that is very important. We don't need to think of any irrelevant cash flow or the cash flow that is not related to our project valuation. We should not consider those, so only pay attention to the relevant cash flow. In this aspect, you need to consider three items: the initial investment amount, that is the lump sum amount of money you need to invest upfront, and then operating cash flow, meaning when you invested some amount of money to a project, and then that project will give you some return, a periodic return. That periodic return is our operating cash inflows. And say your project you estimated will survive for next 10 years, but after 10 years, if you have something to sell out of that project, I mean the salvage value. So that salvage value is the additional cash inflow to operating cash inflows. I mean that additional cash inflow is all about our terminal cash flow. So we need to think of these three items in relevant cash flow estimation. Let's consider this example. Based on this timeline and cash inflows, so this is a project, and that project requires actually $50,000 upfront cash investment. That's our initial investment, and this $50,000 investment project will survive for next 10 years, will give us this random number of cash inflows over the 10 years. And after 10 years, the project can be sold at $25,000. So this $25,000 is the additional cash inflow to this operating cash inflow $10,000. So terminal cash inflow would be this $25,000 plus $10,000, so altogether $35,000. And initial investment would be $50,000, and these are the periodic cash inflow over the 9 years, because at the last year we added this $10,000 to the terminal value. So three component: initial investment, operating cash inflows, and then terminal value. So terminal value includes the operating cash flow of the last year. So these three important component for our relevant cash inflow estimation. Now going back to our cash flow example. So $14,000, $14,000, $28,000, 12, 10, 10, 10. So how we can estimate these future cash inflows? These are projected cash inflows. So to project future cash inflows, we need to uh, be very careful of potential pitfalls. So what are the potential pitfalls? say project cash flow versus accounting income. So, the basic difference between accounting and finance is all about the method of recording. Accounting record is transaction, is cash flow based on the transaction, no matter whether actual cash received or not. I mean, actual cash flows happen or not. But finance, it records cash flow when actual cash flow, it records transaction, or I mean, it considered cash flow no matter when transactions happen. For example, one product sold last year, but the money did not receive last year, and then money received this year. Accounting people will record that, okay, the sale of that product that happened last year, so cash inflow would be in the last year. But finance people will not consider that cash inflow in the last year, no matter the actual sales happened in the last year but the cash received this year. So you see that difference between recording of cash flows with respect to finance and accounting. So if something happened last year and you record it, that's not true in finance sense because you did not receive cash flow. But if you sold the item last year and you receive cash flow this year, so you should add that as additional cash to your total cash flow estimation. That's the one pitfall. So if you do not record the cash you received, that the transaction actually happened last year, it would be a wrong estimation. Then second, the cash flow effect of particular purchases and depreciation. So think of a company. If we say company will grow, so how company will grow? Definitely company needs to buy assets or other fixed asset. And if company buys asset, so the expense, the lump sum amount of money, actually we do not report in the profit and loss account because this is fixed asset, it is a revenue generating asset. Rather, we use some portion of the total value as a depreciation in our profit and loss account. So if we ignore calculating this depreciation in our cash flow estimations, again our cash flow estimation would be wrong. If I can give you one example, say um traditional what traditional profit and loss account, say image profit and loss account. If I open it, okay, see, sales revenue minus plus service revenue, interest revenue, meaning these are the income, and then expense, OS, advertising, office delivery, depreciation. So these $2,900 we deduct from this total revenue, and this depreciation comes from a big purchase. I mean the fixed asset purchase. But think of this depreciation, we are deducting 2,900 from this revenue. But do you think this 2,900 actually happened? Depreciation, meaning actual cash flow did not happen, but we deduct this $2,900 from our revenue to give to show our net income. So if we want to estimate cash flow, then we need to add this $29,900 back because we deduct this amount, but actually this cash flow did not happen. So we need to add this amount back. Okay, now, okay, where we are. Mm, so we need to add depreciation back to estimate our cash flow. Then changes in net operating working capital. Changes in net operating working capital meaning, let's talk about the working capital definition first. So what's our net operating working capital? Meaning the difference between current asset and current liability. So current asset minus current liability is our net operating working capital. And changes, say last year net operating capital was $500 and this year net operating capital was 550. So what would be our changes in operating working capital? Definitely 550 minus 50 would be our 50. So if 50 is the I mean increase in net or operating working capital, so that means company actually invested $50 more in in inventory or other current asset. uh, let's see if we have example in our PowerPoint. Okay. Where is the example I saw somewhere? Please bear with me. Okay, here we go. So say company sales projected for next 4 years and net operating working capital is this. So let's consider this year. Can we just like this? So 742, meaning changes in net operating working capital. So second year net operating working capital is 25,462, and then the previous year net operating working capital was 24,720. The difference is 742. See, this number is lower and this number is bigger, but why it is negative in front of 742? Because 742, if we just delete 742, so that changes in net operating working capital compared to year one. In second year we have $742 more. So more meaning company actually experienced more cash outflow. Why? Because company purchased inventory more than previous year. So if company purchased seven inventory by $742, so this $742 actually cash outflow occurs. That's why it should be negative, meaning the impact on cash flow would be negative, because this $742 uh, actually has been spent additionally compared to the last year. So we need to deduct this amount from our cash flow so that we can get the actual projected, I mean, more accurate projected cash flow. If we do not adjust this one, then we will end up with wrong cash flow estimation. So if we end up with wrong cash flow estimation, our ultimate project evaluation would be wrong. Okay, then for third, interest charges are not included in project cash flow. Interest charge. I'm using PowerPoint and then supplementary together. Don't be scared and don't be lost. Okay. Okay. Should you subtract interest expense or dividends when calculating cash flow? See, answer is no. Why? Because when we discount projected cash flows, that discounting rate actually comprises of interest rate as well as cost of equity. So if interest rate already capture this increase interest expense or dividend for cost of equity, we don't need to think of this interest expense in our cash flow estimation, because this part already taken care by our discounting rate factor. So additionally we don't need to consider about this interest expense or dividend in our cash flow estimation. If you if you forget, I mean, if you add this interest expense again, then you will end up with wrong cash flow estimation and your ultimate evaluation will be wrong. Fourth, timing of cash flows, yearly versus other periods. Definitely, if you can estimate cash flow more frequency, meaning semi-annually, quarterly, monthly, weekly, daily, or even hourly, that would be better. But do you think it is feasible to estimate cash flow on hourly basis of a big company? No, this is not. Quarterly is fine, semi-annual is fine, but yearly is the most standard, because company can accumulate all of its transaction in a year. So yearly would be better. Sunk cost. Think some of the costs that actually happened, and and if you proceed to invest in that project, or if you do not proceed to invest in that project, you cannot get this sunk cost back. So if you cannot get it back, no matter you accept the project, I mean you invest in the project or you do not invest in the project, you cannot get it back. So you should ignore it in our cash flow estimation. Second, opportunity cost. Think, if you have something already and if you do not invest in there, still you can earn money. For example, say if you have a one building and you are thinking to uh, use that building as your manufacturing facility. So if you do not use that building, I mean do not establish your facility, manufacturing facility in that building, still you can rent that building to someone else and you can earn money. But if you use that building as your additional manufacturing plant, then you need to consider the opportunity cost. Meaning, if you do not invest, I'm sorry, if you do not use that building as your additional manufacturing facility, you could earn money as a rent. So, but if you use that building as your additional manufacturing unit, the cash flow you will receive and the cash flow you will get, except using that building as additional facility, we need to deduct. I mean, I don't know whether you understood this. Let me use this as an example. Say the building rent equals 100,000 if you do not use. But if use the building as additional facility, then your income would be say $250,000. Then you should consider this as opportunity cost. So your net cash flow would be $250,000 minus the additional I mean 100,000. So it should be 150,000 would be your net cash flow. If you forget to deduct this opportunity cost, then your cash flow would be $250,000. So that would be some inflated amount of cash flow estimation. That's definitely would be a wrong idea. So you need to consider cash flow, I mean opportunity cost. Other pitfalls in cash flow estimation is externalities. So negative within firm externalities, positive within firm externalities, environmental externalities. So negative within firm externalities meaning, say what should be one example. Okay, say iPhone 14, iPhone 15. If there are no iPhone 15, definitely people will buy iPhone 14. But iPhone 15 came, that's why people will not buy iPhone 14. People will buy iPhone 15. So just because of introducing new product, the old product sales decrease because the customer will get the new one, not the old one. So since this new version of the product actually eat some of the sales from the older version, so that is our negative externality. So this should be, I mean in marketing term it is called product cannibalization. So introducing new product actually reduces sales of the old product, I mean the in the same category. So you should consider that loss in cash flow estimation. Positive within firm externality meaning, what could be the example? Um, say if you buy iPhone 15, then definitely you need to buy some case or maybe battery, cable, something like that. So just because of iPhone 15 you bought, you need to buy this battery cable, I mean charger cable and case. So this is some positive externality for the firm, meaning because of iPhone 15, companies sales on case and charger charging cable sales increased. So this is positive, you should add it. Environmental externality, meaning say we also live in a society. Company operates its operations in environment, I mean in our community. So if company, say for example, releases some of the toxic gas, so that is the bad thing to our environment. And if bad thing actually occurred by the company, government actually fine the company. So company actually needs to consider that potential penalty, or find some alternative option, for example replacing its manufacturing machine that reduces less toxic gas to the environment. So that is a cost, and that cost should be taken care in case of estimating incremental cash flow. Okay, so basic format for determining initial investment is, first of all, install cost of new asset, meaning the amount of money you spend to get a new asset, plus how much you spend for the installation cost. And if you replace it, then how much you got as a sale of the old asset, plus some tax adjustment and changes in net working capital. So these two, 1 plus 2, and this, if it is positive we need to deduct, if it is negative, I mean net working capital negative, um, we need to add it. That way we can get our initial investment cash flow. Let's go to our PowerPoint. What we have there, one item is incremental cash flow, meaning corporate cash flow with the project minus corporate cash flow without the project, meaning just kind of you adjust the opportunity cost. What else? Sunk cost. Definitely, we should not consider about sunk cost because this is already done. No way we can get it back. Incremental cost. Uh, say, suppose the plant space could be leased out for 25,000 a year. Would this affect the? Of course, this is opportunity cost. We need to consider in our cash flow estimation. Externality we already discussed. Okay, basis for asset depreciation. Uh, Initial cost, meaning purchase cost plus shipping if you have to pay installation cost. Just like consider house purchase. The house price is something, but you have to pay the closing cost. So and after buying the house, if you renovate something, so the purchase price, closing cost, and then renovation all together would be your depreciation basis. Okay, what else? Inflation we need to consider in our project cash flow estimation, because we know nominal and real rate, I mean inflation actually capture our purchasing power. So if you do not adjust inflation, your cash flow would be some inflated amount, I mean would be wrong answer. So you should consider this inflation adjustment in your cash flow estimation as well as project valuation. If you discount real cash flow with the higher nominal, then your NPV estimate would be too low. So if it is too low, meaning you will reject this project. But actually, it is not true if you consider nominal cash flow. So that way, if you use nominal cash flow, use the nominal cost of debt or real. But if you use real, don't use nominal cost of debt. That's the idea. Okay, I think pretty much it from our chapter 11. Let's try some practice problem based on this chapter. I think this part we don't need to think of because we will not cover the risk analysis in this chapter. Mostly the cash flow estimation will be fine. So thank you.